The dollar is not distressed at the moment, but these treasury market actions are wartime actions, and they could lead, combined with the oil shock, such as the 70s, they could lead to a run on the dollar. That's the recipe that I see here. You could argue that alongside the shifting demand for dollars vis-a-vis gold, you're seeing a shift in the demand function for Chinese debt. Even though it's not fully integrated into the global financial system, that various ways to get exposure to Chinese debt are becoming more attractive vis-a-vis US Treasuries. There have been rumors for years that at some point China would feel it had accumulated sufficient gold reserves to announce at some point, when convenient, when they thought it served the national interest, that Chinese bonds would henceforth be redeemable in gold. The successor to the dollar will be a gold-backed currency. And that is yet another step along the road of full-on gold remonetization at the international level.
Welcome back to the Microscopic Podcast. My name is Alexei Dronov. I'm your host, and today I have the pleasure and the honor to welcome back my friend, John Butler.
Alexei, hello.
So last time we spoke, John, was in South Africa. We had this retreat for a week. We had amazing content, amazing backdrop, some activities, and we discussed a lot of very important topics. So I also urge the listeners and the viewers to have a look at those sessions. We had, I think, 4 roundtable sessions, one-on-one interviews, and a lot of what we actually discussed back then is more relevant than ever now, I would say. Today is Friday, 21st of August. To put things into perspective, markets are shifting not on a daily basis, on an hourly basis. I noticed, especially the past days. We will cover important topics as like the elephant in the room, obviously the sovereign debt crisis, and starting with Japan and the bond market, the treasury market now in the US with heavy interventions and all that. So let's start with this and also then see what the implications are on a more global level, but also more precisely in gold and silver and other assets. So let me first start with this question, John. What is there to understand with what we're witnessing now with the 30-year yields, the long end of the yield curve for the treasuries in the US is getting higher? Scott Bessent tried to intervene with a few of the repurchases of the long end. We've seen actually that this within the day reverted to its level. So help us understand what is happening here.
Wow. Well, you could argue a bit of monetary history is happening here. I believe this is a big deal. And I'm not alone, by the way. Many people think this is a big deal. Last week, we saw the U.S. jointly intervene with Japan to intervene in the yen, dollar-yen exchange rate, euro-yen exchange rate. You could argue the ulterior motive there was to prevent Japan selling even more treasury bonds than they otherwise would have done. And now you're seeing the United States, Secretary Bessent, announce that he's going to be buying back even more long-dated treasuries than previously planned. Now, of course, if you're going to buy back long-dated treasuries, you need to finance that somehow. So how do you finance it? Well, you finance it with short-dated debt. So the U.S. has made a decision now to try and prevent foreign countries selling treasuries and to sell more short-dated debt to buy back long-dated treasuries. Why? Because the United States appears to believe, and there's good reason for this, that the treasury market needs this support to prevent yields rising. Because if yields rise, that's going to kill the economy. And they're desperate to keep the economy going. We have elections coming up. We have a war to finance. We have a huge deficit we're already running. This is desperation disguised as policy. I think that's the simplest way to explain it.
So if we now look at also, I mean, we've talked about the long end of the curve, and it seems like that there's also, if we look at the steepening, there's not per se a steepening. It's rather flat if we compare like the spread between the 10-year, the 30-year, the two. I mean, if you go across like all the board of the whole treasuries, and the problem seems to be that the long end is not high enough. It's not necessarily that it's already high, but it's not high enough compared to all the let's say shorter term treasuries. Um, what is the underlying problem?
Well, keep in mind that the Treasury's existing program was to buy back everything from 10 years on out at a regular rate. Now they're saying they're going to buy it at an even faster rate. But again, 10 years on out. So other factors equal, that's going to flatten the curve a bit as you get farther out. Now, you mentioned the 2-year yield. The thing is, there is a relationship at the long end of the curve and the short end of the curve, which is kind of mathematical. It has to do with the arbitrage opportunities that are available to bond traders when they choose to play the curve, arbitrage the curve. A change in the slope and shape of one part of the curve will affect other parts of the curve indirectly. It's bond math, if you want to call it that. So it put it this way: the normal relationship across the entire curve breaks down when even one part of the curve is being manipulated. The manipulation does not only impact that one part of the curve. And in fact, back in 2002, I wrote a lengthy paper on precisely this topic because the Fed chairman at the time, Fed governor at the time, Ben Bernanke, before he became chairman, wrote a paper detailing ways in which the Federal Reserve might go about manipulating the Treasury curve if they felt they needed to do so for extreme reasons. And this was something he talked about. And so I wrote a paper on the back of that, which drew out the bond maths. It's a little bit technical, but the point is, the moment you start manipulating the yield curve in one area, other areas have to adjust. And it means the curve won't look normal, as it were.
There's a lot of commentators, and obviously, if you go on social media and especially on X, so formerly Twitter, there's always chatter about what this is and interpreting this in different ways. And one of the things I saw recurringly is that this is a form of QE, that the Treasury buybacks are a sort of QE, but it seems to be quite different, isn't it?
It is and it isn't. You could argue in its general macroeconomic effects, it has a similar impact on the Treasury market and by extension, everything that trades off the Treasury market, such as the mortgage market, other forms of borrowing, and economic activity, which is financed with those forms of borrowing. However, technically you're right, because QE, in a simple sense, is simply taking debt onto the central bank balance sheet. And here, you're shifting debt from the long end of the curve to the short end of the curve. So technically, in a narrow way, yes, they're different. But in terms of their broad macroeconomic effects, they're not terribly different. The reality is that the Treasury, in this case, with the support of the Fed, we can't leave the Fed out of this. And actually, it's intriguing that Warsh, the new chairman, has just showed up, and these events are happening. It makes me think that Warsh was already aware that this was part of the plan before he showed up. But who knows? Anyway, this is designed to protect the Treasury market. It's designed to protect the economy, but those can only buy time. The same way QE can only buy time. And it makes you wonder what will happen after the elections. It makes you wonder what will happen, assuming the Iran war eventually gets settled somehow. You can't continue doing things like this and not undermine the dollar dramatically and possibly permanently.
Now, I would say it would be also interesting to, and you're a student of history as well, to kind of look back on when did we have a similar setup with higher yields. This was pre-2008 already the case. It was the case also the early 2000s, before in the 90s. How does this compare then if we look at all the major times or periods in the 1970s, the bond sell-off of 1987 or even 1994, um, and even 2008? How would you then plot the different settings or circumstances with what we have today, and how is this time different?
It's interesting you point out those historical episodes because today contains elements of several of them. Let's go back to the Second World War. It was decided during the Second World War that the best way to finance, in the US, the best way to finance the war effort was to cap Treasury yields at 2.5% and to have a huge PR campaign to encourage households to fund the war with so-called war bonds. So you tried to find a new investor base for the Treasury market, yet you were also capping yields. And so there was this big patriotic, PR effort to try to get every household to at least buy some of these so-called war bonds. But you didn't allow yields to rise to a level that would naturally clear the market. And that continues until 1954. That is, this cap on Treasury yield is not removed until 1954. And by that time, President Eisenhower had made a lot of progress in reducing the deficit. And in fact, President Eisenhower will be the last U.S. president to oversee a federal surplus, budget surplus, as opposed to chronic deficits, the way we've seen in modern times. Okay, you mentioned the 1970s. Yes, we had the oil shocks in the 1970s. We're getting one of those again today. They were hugely stagflationary. But eventually, Paul Volcker decided, that is, Fed Chairman Paul Volcker decided that had to come to an end. He raised short rates to around 20%. Long rates went up to, I forget exactly where they peaked out, low teens, I believe. And that was very, very damaging to the U.S. economy. But what it did do is it helped to shore up support in the dollar. Because in the late 1970s, there was a run on the dollar. The gold price was soaring. The silver price was soaring. The dollar was falling versus multiple other major currencies. And indeed, that was such a big deal that Hollywood made a big budget film about it called Rollover. If you've never watched Rollover, you should watch the film. So here you have a situation where the dollar is not distressed at the moment, but these Treasury market actions are wartime actions. They are reminiscent of wartime actions, and they could lead to, combined with the oil shock, such as the 70s, they could lead to a run on the dollar. That's the recipe that I see here. It doesn't necessarily unfold tomorrow, this week, this month, but that's the mix we're looking at based on history.
All right. So another question is, who is Jane Fonda in all this?
Yes, she starred in the film. Again, this is a big budget Hollywood film, Rollover, starring Chris Christopherson, Jane Fonda, and Hume Cronin. And Hume Cronin's character is brilliant. He's this old financier. He knows everybody. He's hugely connected, and he's confident that his actions behind the scenes will manipulate financial markets in a way that will maintain stability. And he constantly reassures others, don't worry, just let me get on with it. Everything will be fine. He literally says that in the film. Everything will be fine. Well, by the end of the film, everything is not fine. Global financial markets blow up. The dollar collapses. Gold soars. I'm not saying that is exactly what's going to play out in the real world this time around. But that film is a fantastic example of just how fragile confidence can be, of just how fickle financial markets can be. And investors who are interested in these developments and who want to watch something entertaining one evening that they might actually learn a thing or two from should watch Rollover. It's great.
I mean, in this case, we're not talking about, obviously, conspiracy of crashing the Western system by foreign investors, like you described in the Rollover movie. But But there is things at hand in terms of well, we can talk about later the impact of the just the sphere of influence that China has on the monetary system as a whole. We can cover this on the second part of this interview, but here I would like to still focus on also the state of the economy in the US, because those higher yields are also a higher borrowing cost for pretty much anyone. We're not talking about just corporates. We're talking about also consumers. We're talking about also the real estate markets and housing. So where is the rollover here? I mean, sorry for the pun here, but
No, that's fine. That's fine. Look, there's no free lunch in economics. And when you intervene in the bond market to try and lower borrowing costs for the government, that doesn't necessarily easily transmit through to the private sector. And in fact, some economists argue that what ends up happening is you effectively crowd out private sector borrowing by subsidizing public sector borrowing. And that may keep government spending going. It may allow government finances to not deteriorate quite as quickly, but that doesn't necessarily support private sector economic activity. I mean, it might at the margins, but the idea that you get full pass through is not necessarily the case. And in fact, when you look at the private sector economy in the U.S., it hasn't been doing well for a while. And I looked at some economic data recently, which I actually found rather shocking. If you look at, for example, the labor market over the past year, the U.S. workforce has declined by 1 million workers, more than 1 million workers over the past year. That's a large decline. You don't normally see that outside of recessions. Now, the official data does not say the U.S. is in recession. They say the U.S. is growing, not very strongly, but it's growing. But the labor market data suggests that the U.S., in fact, is in recession. We've also seen some very weak retail sales data recently, which normally you would associate with very weak, if not outright recessionary conditions. So the U.S. economy is perhaps not doing as well as people previously thought. And in fact, I believe that a lot of economic data fails to capture what is really happening in the economy during periods of inflation, because measuring inflation is difficult. It can be quite subjective. And ever since COVID came out back in the early 2020s, we've seen these waves of inflation rolling through. And now, of course, we're getting a wave of inflation rolling through due to high energy and other commodity prices, partly, or if not entirely, as a result of the most recent Gulf War. So I'd be skeptical of a lot of economic statistics, especially when they don't line up. When they don't line up with one another, you have to wonder what's going on. And my take, when I look at these inconsistencies, as it were, in the data, is that the U.S. economy is not doing particularly well. This attempt by Treasury Secretary Bessent to suppress long-dated Treasury yields may help the government, but I'm not sure it's going to help the broader economy.
I mean, if we then look at what those yields were already happening in the past, right? It's not that we haven't seen those yields before. And you've mentioned that there were different episodes, different circumstances. But what specifically makes them potentially destabilizing now?
Well, the fact that the U.S. debt to GDP ratio is historically very, very high. It's even high with respect to World War II. And the U.S. economy is fundamentally not as dynamic as it used to be. That is, the tax burden is far higher. The workforce as a portion of the overall population is far lower. You've had a lot of structural changes in the economy that make it more difficult for the U.S. to service its debt. And I mean, not to be mean. I mean, I live in Great Britain, and the same is true in Great Britain and continental Europe. The fact is, the U.S. economy looks much more like the continental European economy or the British economy than it used to. It used to have a structurally lower tax burden. It doesn't really anymore when you add in state and local taxes along with federal. It used to have a smaller welfare state. it's still smaller, but not dramatically smaller than what you find in much of Europe and Great Britain. And so the US economy is not quite the dynamic free market entrepreneurial economy it once was. Still more so, but the difference is negligible now. And so I don't believe that the US is in a good position to retain investor confidence as the debt burden, the federal debt burden, continues to rise and rise and rise as a result of this war, as a result of what is an economy that is weaker than it might appear on the surface. And so I do believe that Treasury Secretary Bessent is sort of playing with fire a bit with these manipulation shenanigans.
We've seen, and that's how I started the conversation, that this $4 billion of buyback operation just evaporated within 12 hours. I mean, that was pretty useless, one could say. And the question is, what will be the next actions undertaken by the Treasury, but also by the Fed? Is there anything that they can coordinate to achieve their goals?
Well, as I suggested earlier, it's probably the case they are already coordinating, if not officially. Now, policymakers, economic officials always like to get markets to do their work for them. They like to speak and get the markets to react in the way they want. Sometimes they actually have to transact, which is what we saw with the yen intervention and what we're seeing with the increase in treasury buybacks. But you want small actions to have big effects. What you don't want to happen is to need to go in with big actions, because that's when you really start to burn through whatever credibility you still have left. And that's when markets really test you. That's what happened in 1992 when Secretary Bessent and others broke the sterling peg to the German mark, right? That's what they were doing. They were forcing the UK to go in big, and they blew up the peg, and they made, I believe the rumor at the time was, they made roughly $1 billion in a single day when that peg broke in 1992. Policymakers never like to be in that position. But the problem is this: it's a slippery slope. You start by talking, then you start with little tweaks and actions. But if those do not generate the desired effect, you can either just give up and stop, but economic officials don't tend to just give up and stop. These are people in power, after all. So you double down. You get more aggressive. The actions become bigger. You grab a bigger hammer. You pull a bigger lever. The problem is that if there's not something fundamentally supportive, fundamentally improved by those actions in the real economy, ultimately it's not going to work. It will ultimately fail. It might buy time, but it will only buy time. It might get you through the midterm elections, but after that, who knows what will happen? This is a very, very, very dangerous road in terms of the credibility of U.S. economic policy generally, and specifically the demand for dollars in the international monetary system.
I mean, there's also things that you could argue that market mechanisms are going to be making the job of Scott Bessent and Kevin Warsh extremely difficult. And the trigger, which Japan was, in a way, we could talk about all the other factors, obviously, but Japan is arguably one of the most important factors.
Yes.
It seems that also the Bank of Japan is losing control of their yield curve. I mean, the 2-year has broken the trend line. They went from 0 in January 2024 to 1.7 now, and it was negative for all those years before. And not only is it the yield is rising that high, but the Bank of Japan owns 54% of those outstanding Japanese bonds, and the debt to GDP is about 250%. And in a lot of conversation I had in the past, there's always talk of Japanification of economies, and that Japan is always a bit the front runner of, so to say, what we can expect in more developed economies post-industrialization, where this is where we see a glimpse of the future. Obviously, there's a lot of other factors. The demographics is also very important, but um, where can we, at least in the case of Japan, expect things to go, even though now they've set up the FEMA repo operations that allow the Bank to Japan to transfer US bonds to the Federal Reserve and so on? Um, what can we expect now? And how can this maybe turn into a huge door into the US's eye in a way?
Well, Japan is the largest foreign holder of U.S. debt by a large margin, very large. The Japanese historically have had a very high savings rate. A lot of that savings has been invested in dollar assets. And so the cumulative foreign asset portfolio in Japan is enormous, and the bulk of it is dollars. The funny thing about Japan is, however, is that yes, they have a huge debt, but they owe their debt to themselves. They don't owe it to foreigners, and they hold a huge amount of foreign debt. So the Japanese are in this unique position where they can actually fund a significant portion of their own debt just by dissaving and selling out of their accumulated foreign debt. And that's always an option. And every time they intervene in the foreign exchange market, that could be part of that sort of policy. It doesn't need to be a one-off. They could do it for years, many years, and help to pay off their own accumulated debt. And so Japan is in this position which is somewhat unique. And comparing the US debt, which is externally financed largely, to the Japanese debt, which is not a like-for-like comparison. That's apples and oranges. The US does not owe its debt to itself. It owes a lot of its debt to foreigners. And so in Japan's case, a weaker yen does not automatically help to reduce their accumulated debt burden. And in fact, if they were to use their foreign asset pile to help reduce their domestic debt, the yen would strengthen. Whereas in the US's case, the debt burden, if it needs to be financed, could be financed through a weaker dollar. And that is always a temptation for the United States to follow that policy. And indeed, what we've seen recently with the increased purchases of treasuries is a possible step in that direction. So Japan and the US are similar in some ways, different in others. But the takeaway, in my opinion, the important one, is that the yen is less undermined by a rising Japanese debt burden, domestic debt burden, than the US dollar is undermined by a rising debt burden that is externally financed. That's where these trends diverge.
Let's maybe also put things also a bit together, also in terms of the impact it has on assets. We've seen gold, silver rise in the last days after, I would say, quite a half a year of consolidation or downward trend. But here, the key difference here is that they rise while real yields are also rising. And this usually is not the, let's say, natural mechanism that these assets, and also including risk assets like Bitcoin, for example, do tend to actually behave. So how do you decipher this, and what does this mean? Obviously, we've talked a lot about this, but more explicitly.
Yes, well, you point out something which I think is extremely important, and which, in fact, I write about in my book and sometimes my other writings on Substack and elsewhere. There is a relationship, a very good relationship, between real yields and currencies. In the case of the dollar specifically, real yields in dollars and the US dollar. And you can look at that versus other currencies in relative terms, or you can look at it versus gold, and which is what we're doing here. That relationship is observable, but it goes through step changes, discontinuous step changes now and again. When you get some sort of shock to the system, and there are several good examples of that. You had one in the early 2000s. You had one in 2008, 2009. You had one when the Ukraine war broke out, and arguably you're getting another one now. What is happening? What's happening is you're seeing a shift in the demand function for gold vis-a-vis dollars, a qualitative shift. For any given level of real rates, investors want a larger gold balance versus dollars for some qualitative reason. In this case, you could argue it's because people sense that U.S. policy is fundamentally changing as a result of these events we've been discussing, interventions, manipulations, and so on. In the early 2000s, the Ben Bernanke, among others, was talking about very extreme Fed policies. In 2008, 2009, of course, we had the global financial crisis. The Ukraine war breaking out was a big deal. All the sanctions, weaponization of the dollar escalated. And now we have the U.S. starting to act very aggressively to manipulate U.S. financial markets. So there you have it. I think that's the best explanation. You're seeing yet another shift in the demand function for gold vis-a-vis the dollar. And that is something that could propel the gold price, the dollar gold price, to all-time highs, because these previous ones have done the same. When you get these demand function shifts, they tend to result in a new all-time high dollar price for gold.
And it's funny because, I mean, I actually would tend to, if I understood you correctly, saying that an addition in real yields would tend to be compensated by a bigger amount of gold is something that I would say is the opposite usually, right? Especially when we talk about the long term of the curve, of the yield curve here, the treasuries. Usually what you see is that investors do like to be compensated with higher yields, and then park their savings, whatever, hedge or whatever you want to call this, into those long-dated treasury bonds. But here it's the opposite, and it signals, as you I think mentioned, the fiscal and the monetary risk, which is a total different regime change, right? I mean, it's also the fact that we've ended the bull market and bonds overall. It's been 6 years that we have one of the worst performing bond markets in a generation. And arguably so, we see it in balances of central banks all around the world, with central banks adding gold more than ever, 1,000 tons on average per year since 2020, and becoming also the reserve asset compared to any US bonds. So what does it say now about this new regime we are in, and how far can this go? Because if we are expected to go back to the 60% dominance that gold used to have in its balance sheet in the 60s, then where does gold go in that sense?
Well, and clearly the market clearing price for gold in any currency is going to be a lot higher if we go back to that. That is the road we're on. We won't get there tomorrow. Well, who knows? Maybe there's a crisis tomorrow, but we probably won't get there tomorrow. But that's the road we're on. Now, I argue in my book that the road we're on is not only that the gold share of assets, official and unofficial, not just central banks, but other investors, that the gold share of assets is going to increase very dramatically over the coming years. I go so far as to argue that as the gold share of assets grows, ultimately countries will begin to use those gold assets to settle external trade imbalances. And that is a form of de facto monetization of gold. So my book argues that that's where we're going. It doesn't argue we get there tomorrow, but that is the road we're on. You can only manipulate the U.S. financial markets so much, suppress yields, intervene in, foreign exchange markets, whatever it is. You can only do that so much. You can only weaponize the dollar so much. You can only, play fast and loose with market confidence so much before the price of gold rises sufficiently that the balance sheet value of gold vis-a-vis dollars around the world becomes so much larger that it becomes literally just more convenient to use your accumulated gold balances to settle external trade than to use the residual dollar balance, which has shrunk so much it no longer is able to as easily settle those imbalances. I believe that's the road we're on. And I do believe there is some sort of tipping point out there when all of a sudden you'll start to see this gold remonetization occurring, not just between two countries, but between 20 or more. The BRICS might do it as a group, for example. They've talked about it. And some argue they've got behind the scenes plans to remonetize gold. I have no privileged knowledge of that, but it makes logical sense if you want to have freedom of action from what has become a manipulated, weaponized dollar. So I do believe that's the road we're on. It does imply a far higher gold price. You and I have discussed this before. You're talking in the tens of thousands, in my opinion, based on the Bretton Woods equivalents of gold balances on balance sheets, official and unofficial. I do believe that's where we're going, even if we're not going to get there tomorrow.
And so now I would like to combine all those topics in one, and this is maybe like the last topic I would like to discuss with you, John, and which is the fact that China's 10-year government bond yields has been falling while the country has actually been importing exceptional amounts of gold, in addition to the PBOC adding to their gold reserves officially. There's of course this whole talk about how much the Bank of China really has, the Central Bank of China. So how would you then interpret first the falling 10-year government bond yields in China?
Yeah, I've been thinking about that because the gap you're seeing now between China's borrowing costs and those in other major economies, including the United States, is historically very, very large. And so it makes you wonder what the hell's going on here. Is the Chinese economy collapsing, for example? Is China heading into outright deflation, for example? That seems unlikely to me based on the fact that China remains a very, very large net energy importer and an importer of other commodities too. So the idea that this is about inflation expectations or deflation expectations, I think is probably not the case. Okay, so is the economy imploding? Is it just a flight to quality? Again, China has struggled. The economy has struggled over the past few years compared to the prior couple of decades. But has it struggled to the point where you would expect the bond market to implode like that? I don't think that's true. And in fact, I've been in touch with some people recently who have been traveling around China, and they say that there are not clear signs of economic distress anywhere they go. That's just anecdotal, but for what it's worth. So what's going on here? You could argue, and this is a bit of a stretch, but I will offer this as a possibility. You could argue that alongside the shifting demand for dollars vis-a-vis gold, you're seeing a shift in the demand function for Chinese debt. That is, there may be a realization domestically in China, possibly in other countries, that given what the US Treasury is now doing, given how desperate they are, given how expensive this war is becoming, and so on and so forth, that Chinese debt, even though it's not fully fungible, even though it's not fully integrated into the global financial system, that various ways to get exposure to Chinese debt are becoming more attractive vis-a-vis US Treasuries. That's a possible explanation here. And I'll go one step further now, and this is way out there, but bear with me. There have been rumors for years that at some point China would feel it had accumulated sufficient gold reserves to announce at some point, when convenient, when they thought it served the national interest, to announce that Chinese bonds would henceforth be redeemable in gold on demand. That is, you could choose. You could just roll them over and redeem them in renminbi and reinvest, or you could take delivery in gold. That rumor's been around for a while. And if anyone thought, gee, I have a choice now. I can get a US Treasury yielding 5% that's not backed by gold, or I can get Chinese paper yielding 2% that is backed by gold. Tough choice, isn't it?
I had this conversation also with someone you're very familiar with, I think, Alistair McLeod, who was saying that the internationalization, sorry if I stumble upon this word, of the yuan would be only achieved through the pegging of gold, or at least a link to gold. And we've entertained, I think, this scenario as well, through also the different, let's say, gold hubs that they would, or vaults, SGE vaults that they would set up in different parts of the world. So far, there's only been the one that we know of in Hong Kong. That is, let's say, outside of mainland China. Well, Hong Kong is now part of China, but and then the one in Saudi Arabia. But what are your thoughts on this? I saw you want to say something about it.
Yes, absolutely. Look, I write about this in my book. Basically, I make the point that the only reason why the US dollar remains the world's preeminent reserve currency is a legacy of Bretton Woods. The US economy is much smaller than it used to be. The US share of global trade is much smaller than it used to be. Confidence in the dollar is much lower than it used to be. The dollar didn't used to be weaponized to the degree it is today through sanctions and so on. And so really the only reason why the dollar retains the status it has is a legacy issue. That is, the world hasn't found a way to move on. So how do you move on? Well, that's the problem, right? No other currency can just step up and say we're better, right? We talked about Japan. I mean, Japan does have, problems, right? They have this huge debt. Again, they owe it to themselves, but they have this huge debt. They have demographic issues. The euro, as we know, the euro area has issues. They have internal debt issues. The ECB actively intervenes to try and subsidize relatively weak sovereign borrowers within the euro area, something which could, at some point, could run out of road. So there's no other currency that can step up unless there's a currency backed by gold. And then it is qualitatively superior, qualitatively more credible, qualitatively a better store of value. And if China is in a position to do that, and I'm not claiming they are, I'm not an expert. I don't know exactly how much gold China has. No one does. I don't know exactly what China's monetary plans are. No one does. Well, some do, I guess, but certainly I don't. But Alistair is correct. If China do want to internationalize the yuan, if they do want to become the new reserve currency, or at least one that is at least able to rival the dollar, if not completely surpass it, they need to back their currency with gold. That to me is obvious. The successor to the dollar will be a gold-backed currency, and that is yet another step along the road of full-on gold remonetization at the international level, as I discuss extensively in my book, right? I believe for many years that's where we're going. I've never known, and no one does know, exactly how that's going to play out. I've gone through many different scenarios. This one may be the most plausible of those.
So now, if we tie it back to the initial question I asked, was about the relationship between the Chinese bond yields and the import. And here, this is a generalization because there's obviously a dissociation between general import into the country of China and what the PBOC is adding to its balance sheet in terms of gold reserves. Could we say that if, let's say, the bond yields begin rising again, that this relationship with the import, or at least on the balance sheet perspective for the PBOC, of addition of gold reserves would then wane? Or is there like another angle to that, or is it a false observation?
Well, in a way, what you're pointing out, Alexei, is how financial markets work. That is, if bonds are more attractive than gold, you own bonds. If gold's more attractive than bonds, you own gold. And interest rates move up and down to reflect that relationship. I mean, that would be a normal relationship. So as Chinese bond yields go down, they're less attractive. Everyone will want to accumulate more gold, in which case yields have to go back up again. And I think the best way to understand, again, this is possibly, I'm speculating here, why Chinese bond yields are so much lower than those in the US and elsewhere, is because of this perceived future possibility that, in fact, this is going to become a gold-backed instrument. So you receive a bit of yield in the meantime, and you have this implied optionality that you get to redeem in gold down the road. And I mean, again, I'm speculating here, but maybe some of that's going on.
And so there's another question I want to ask you. And since you've been a director at, if I'm not mistaken, at Deutsche Bank, you might also have maybe some perspective on, or at least know, let's say, a bit more background information about the way Deutsche Bank operates. But it was about the fact that the Deutsche Bank has become the first non-Chinese European bank that has been authorized to clear renminbi transactions in Europe, if I'm not mistaken. But even though, well, the bank is German, the government, Germany's government itself, says it wants to de-risk from China. So it's quite the opposite signal here. What do you make of, first, the fact that it became a clearing, a renminbi clearing bank in Europe, and the fact that it might entail other things that we've just discussed now previously about the ambitions of the internationalization? I have really a problem with this word today.
Look, I lived in Germany for years, and I believe that Germany's instincts politically have, in recent decades, been to try and maintain good relations with all major countries, Russia, China, and so on. That situation has become very, very complicated as a result of the Ukraine war. And the current governing coalition in Germany clearly uh, believe that they need to be on the side of NATO, the US, and against Russia, which by implication, of course, means that they cannot be particularly friendly towards China, because everyone knows that China is a huge consumer of Iranian oil exports as well as Russian energy exports. So Germany is really in a bind and really conflicted. If you were to take a survey of major German business executives, including Deutsche Bank, and ask them, would you prefer to be able to remain neutral in these conflicts and just do business and just make money and just import cheap Russian energy and get, Deutschland AG, or Germany Inc. in English, get it up and running again? I think a sizable majority would say, yes, absolutely. Let's just get on with it. But the government, as it's currently constructed, for whatever reason, is acting against those interests. That won't last. In my opinion, that won't last. And I don't know exactly how long it takes for Germany to go back to business, but it will happen, in my opinion. So the fact that Deutsche Bank is trying to build a future relationship with China, a special relationship with China, does not surprise me at all. I would expect, discreetly behind closed doors, most large German companies are retaining warm relations with the Chinese Communist Party government and Chinese companies with whom they've worked in the past and would like to work in the future. They are doing everything they can to keep relations cordial, and they are patiently waiting for these conflicts to end. And when they end, these German executives will get back to work. And hopefully that will be of tremendous benefit to the German economy. I certainly hope so. But that's my best explanation for what's going on.
One could say this could be also the path for building renminbi reserves, renminbi trade invoicing, or even eventually the gold-linked settlement that we've mentioned earlier on.
Oh, certainly. Certainly. I mean, look, Germany does not have a modern history of being a major financial center. I mean, don't get me wrong, Frankfurt, obviously is an important financial center for Germany itself. But with the exception of the ECB just happening to reside there as a result of treaty convention, it's not disproportionately important. That could change. And certainly Deutsche Bank would like to see Germany have disproportionate financial influence in the future. And so again, I think their motives are quite clear, and those might conflict with the current government, but there's only so much the current government can do to stop them behaving in that way.
Now, if we look at the renminbi in general, there's also the capital control and the limited convertibility constraint that also plays a role, right? If it
Yes,
does
of course. Yes. Look, as I mentioned earlier, right, as it stands today, the infrastructure is not fully in place. It's not. But you've got to the point where, again, if China is confident that they have sufficient gold reserves to back the currency, and if they're confident that they have sufficient international support for a gold-backed bond market denominated in renminbi, the remaining steps that would need to be taken to properly internationalize the currency and make it a reserve currency to compete with the dollar, there aren't that many. There aren't that many. The gold backing is the hard part, and that part may be more or less done now. And keep in mind, China remains a large net exporter. So the gold backing is really a liquidity mechanism. That is, they don't actually need to be able to provide the gold externally because they're the ones exporting. So they'll just keep accumulating more gold. But you'll still need the gold for liquidity purposes. That is, as a bond matures, you still need to pay off the bondholders, right? So you need enough for that liquidity management, but presumably the structure of the Chinese economy will remain such that it remains a net exporter for some future period of time. Not forever, perhaps, but for some period of time, given the structure of the global economy as it stands today. So once they cross that line, then these final infrastructure steps, payment systems, settlement conventions, confidence building, there's not a whole lot more to do, in my opinion.
All right. Well, it's I guess time will tell, and we'll see how those things develop. And obviously, we will keep on talking about those topics in our future interviews, John. Thanks for your precious time. You also write, as you mentioned in our conversation, you have regular newsletter reports on thorough reports on Substack that you write. You are also on X, I think. And is there anything else you would like to share with the viewers and listeners?
Well, thank you for everyone's attention. Look, I've been thinking and researching and writing about these topics for many years now, since the early 2000s. I've hardly got everything right, but it's been exciting just to see things develop as they have, and to try and stay as on top of it as possible. And I continue to do so. So anyone who is interested in these topics and would like my unique perspective as someone who's worked as a managing director at major financial institutions on both sides of the Atlantic, and yet who went a bit off-piste some years ago, Yes, please go to my Substack, the Amphora Report at substack.com. That's probably the best place to learn about and become familiar with my work.
And you're also the author of The Golden Revolution. We talked about this, your book as well, in Cape Town. I urge our viewers and listeners to also have a look at this interview, which is more of, let's say, your foundational thinking and thesis about all this, which you spilled over, obviously, in this interview as well. Thanks again, John.
Thank you, Alexei. My pleasure.